Good morning, everyone. I'm Steve Lee. This is Ren, and we're both very happy to be here. Honored to be able to kick the day off. So we're here. Well, let me just start. We're here to talk about a new project we launched a couple days ago, the Bitcoin Consensus Analysis Project. As you can imagine, this is anytime you're talking about consensus, it can be spicy and controversial. There's a million different views on it, but we decided to take a stab at it. What motivated us to do this? Well, first of all, Bitcoin is hard to change. I think everyone in the room knows that. Everyone in Bitcoin knows that. And it's really important that it's hard to change because it's a property that's critical to the value of Bitcoin itself. But what actually keeps it from changing? And that's a really complex, there's a complex answer to that question. And if we do want to improve Bitcoin and make a change, how do we go about that? What risks does that present? So that's what motivated us to work on this project. Earlier this year, Avichal Garg and myself were talking about these questions, and that was sort of the genesis of the project. Ren works at Electric Capital with Avichal, so Avichal put me in touch with Ren. He was able to dedicate a lot of his time to this project, myself as well, and then Lynn Alden has been the other major contributor to this project. We felt like that was a good mix of people to start this. We also had over 24 people review this, and we chose people from all over the space, people from the mining space, protocol developers, application developers, people at major ETFs, to get many different viewpoints. And we also chose people who are more on the conservative side of changes to Bitcoin and people more on the progressive side to change Bitcoin. So we thank all those people for that review, but now it's an open source project, so we welcome contributors from all over the space. What is this not? Like, what are the non-goals of this project? Number one, it's not taking a perspective on whether Bitcoin should change or should not change, or the pace of change. It's also not advocating any particular change. That's not a goal of this project. And then lastly, it's not intending to be a blueprint for how to change Bitcoin. It's just attempting to observe how Bitcoin operates. How does it maintain consensus? And if there is going to be a change, which there have been changes historically, what can that look like? So a few contributions from this project and the initial paper. One is that we described 6 distinct stakeholder groups. Ren's going to walk through all of those. There's also different states of mind that a stakeholder can be in. Ren will speak to that. There's also, with each stakeholder group, each group has certain powers and incentives, and that can shift over time through the life cycle of a consensus change. And then lastly, we explore one particular way to upgrade Bitcoin, which has some associated risks. So we'll walk through that as well. And it has certain implications and insights that we learned by exploring that. So with that, I'll hand it over to Ren.
Cool. Thank you. One of the first areas that we dove into is trying to identify the different entities and people who comprise Bitcoin. In Bitcoin, each major stakeholder group possesses certain powers that is driven by a set of incentives that shape how likely they are to wield these powers during consensus change. Entities may belong to multiple stakeholder groups, leading them to exercise various powers and navigate a mix of potentially competing incentives. For instance, you might have a wealthy investor who might also be a large influencer or might have a business that could operate an economic node. They might also engage in mining, employ protocol developers, and have media influence. We try to make these stakeholder groups as orthogonal as possible, such that they do not have meaningful overlap in their powers or incentives. To kick off with the first group, although this group is investors. Although investors do not play a large role in the day-to-day operation of Bitcoin, they impact the price of Bitcoin by buying or selling. Investors tend to have a thesis for why they hold Bitcoin. Thus, changes in Bitcoin consensus could affect that thesis either positively or negatively. And consequently, the incentives to the miners for the amount of hash rate security the network has could be impacted. Bitcoin's price also has broader impacts beyond just mining. It can drive venture capital funding for new businesses, affect funding for open source developers working on software related to Bitcoin, and stimulate overall investment, leading to innovation in products and services that surround the network. Investors can also be large individual holders, institutions, sovereign wealth funds, ETF, etc. They signal their preferences for proposals mainly through markets, so either futures markets and influence price through buying and selling, and they sometimes also will fund development efforts for advocacy for specific changes that might align with their incentives or their thesis. The second group I want to talk about are the economic nodes. Economic nodes are full nodes that not only validate and relay transactions, but also receive and send substantial amounts of Bitcoin. These nodes are distinct from any regular node who are just validating blocks and transactions, in that if you were to draw a graph of all of the flow of Bitcoin throughout the network, these economic nodes would have a high degree of centrality within that graph. These economic nodes are typically operated by businesses and institutions that handle significant volumes of Bitcoin transactions, and they often serve as bridges between Bitcoin and the traditional financial system, providing a venue to swap BTC for fiat currencies or other cryptocurrencies. They tend to include exchanges, payment processors, and the growing RPC providers. Those are node running services. In terms of powers, they have the ability to define which fork is Bitcoin, setting ticker symbols, rejecting blocks they consider invalid, list or not list markets for spot and derivatives for forks, and in some cases might even sell fork coins on behalf of their users without their permission. They tend to be incentivized to maximize their transaction volume and trading activity, and maintain the security and stability of the network, and often fall within some regulatory jurisdiction. This slide is a bit out of order, but there tend to be 4 large segments of investors to break that group apart. On the first group is self-custodying. So self-custodying owners are actually most likely the largest holders of spot Bitcoin. They tend to self-custody their Bitcoin. They're proprietary owners of Bitcoin. The second group are institutions. So think sovereign wealth funds, venture funds, liquid funds. The next group, corporations. So for example, like a Tesla or a MicroStrategy, ETF, BlackRock, Fidelity, the building that we're in, Bitwise. They're distinct because they have different degrees of speed in reacting during consensus changes, especially contentious ones. So for instance, self-custodying owners of Bitcoin move the fastest because they self-custody. They are not beholden to any owners, and they aren't necessarily constrained by a fund mandate. Institutional owners of Bitcoin tend to move slower because they use qualified custodians. So for example, Coinbase, Cobol, Anchorage. They have to wait for fork support from their qualified custodian, and they may also be constrained by mandates. For example, certain institutional owners of Bitcoin might not be able to participate in futures markets or chain split token markets. Corporations tend to have a low to medium speed of reacting because they're usually using Bitcoin as a treasury asset. And ETFs tend to be the slowest currently, but that could be changing because under the current regulation set, they have to abandon their rights to forked coins and just pick one fork as BTC. Media influencers also play a crucial role in shaping public perception. Their influence can significantly impact the direction of consensus decisions by swaying public opinion. They include media, press, thought leaders, organizers of conferences such as Blockspace Media with OPNEXT. Thank you for having us. They help shape narratives that can sometimes distort the perceived support level of consensus changes, either aggrandizing or minimizing. And they can amplify and critique various stakeholder positions. They serve an important role in educating the broader public about Bitcoin developments. And they tend to want to generate engagement, grow their audience, maintain credibility, and they tend to act in their sponsors' best interests. Miners are the next group, a very important group. Miners are individuals or organizations that use specialized hardware to find a block template and non-stat in a combination, produce a hash less than or equal to the network's difficulty. Miners also have historically signaled readiness for consensus upgrades that help other stakeholders determine that it is safe for them to upgrade and for users to use the new upgrades, but does not provide a guarantee. In the current environment, miners rarely run Bitcoin software to construct block templates and thus do not directly control which consensus rules to follow. Only a handful of pools do. However, the switching costs tend to be low for a miner to switch to another pool. Protocol developers, including the group often referred to as core developers, refers to the developers proposing and implementing consensus changes in addition to maintaining the Bitcoin protocol and client. Protocol developers do not have unilateral power over Bitcoin because the clients that economically meaningful stakeholders choose to run is what defines the rules of the network. If the protocol developers were to make like a crazy change, the other stakeholders would simply not run that version of the client. However, maintaining the reference client is quite powerful because it provides the protocol developers with veto-like power because of the difficulties of growing the adoption of an alternative client. And that's something we'll discuss later on in this paper. Users and application developers. This group is quite a large group in terms of count. This group represents those who actively use Bitcoin for various use cases, ranging from store of value to developers of scaling solutions such as Lightning, sidechains, L2s. Various new forms of assets are starting to emerge within the DeFi and NFT space. We also have equity investors in Bitcoin businesses listed here because through their stake in that business, they tend to be aligned in terms of interests. There tend to be two subsegments of users and app developers. That's a bit nuanced. On one side, payment providers and medium of exchange. These transfers tend to be bilateral, so they don't tend to write lock, and they don't tend to have a lot of contentious write locks. But I know there are some exceptions with like timeout trees. And on the second hand, for utility types of apps such as DeFi or NFTs, especially with pool-based trading or lending, you could get hundreds, if not thousands, of transactions all trying to write to that same piece of state. So those types of applications tend to have a lot more write conflict. And between the two, utility applications probably benefit more from expressivity and programmability and probably are a bit less fee sensitive because those utility actions, the user often has some expected return in their head to offset higher costs. So there are a few different state of minds, ranging from passionate and advocate for a change, supportive of a change, apathetic or undecided, unaware, not supportive, but not to a degree, passionately against a change. And most of the time, most stakeholders are kind of in the middle. They're apathetic or unaware. And the goal of this project is to really push people towards picking a side. The process of reaching consensus for SegWit, we can kind of see in this heat map the various powers and actions and reactions in this repeated game taken by stakeholders. Stakeholders also have varying degrees of relative powers during consensus changes. This chart is based off of our qualitative thoughts on the dynamics between the stakeholders. In the pre-signaling period, protocol developers and media influencers have a large degree of power in that they propose, advocate, and implement the consensus change for the protocol developers, and the media influencers try and advocate for that. During the signaling process, the miners gain power because they have the ability to signal readiness. During this period, futures markets for contentious changes will also tend to emerge, so the investor power increases. Once the activation threshold hits, economic nodes become the most powerful in the network because adoption of the consensus change requires the nodes on the network to adopt that change. And investors also tend to have stronger powers in this period, especially during contentious consensus changes due to the emergence potentially of chain split tokens.
Thank you, Ren. Okay, switching gears a little bit. I'm going to talk now about actually changing consensus. I mean, if we look at Bitcoin, it's bigger than ever by almost any metric you want to measure. The price, the number of people involved, the number of companies involved, the number of miners, etc. And that leads to it being harder to change than ever. There's just more people, more money at stake. It's also harder to determine whether there is consensus on a change and how to measure that. Historically, so Bitcoin's hard to change, but it has been changed, right? There's several changes we can look at history and see how Bitcoin has changed. Now, they've typically been done. First of all, they've all been merged into the Bitcoin Core project. The Bitcoin Core project is the dominant implementation of Bitcoin on the network. Something like 99% of nodes run Bitcoin Core. There's good reasons. It has a strong track record of security, of being conservative for changes, and just being high quality. So it's earned its trust. And so all changes that have been done have been merged into Bitcoin Core. And most changes that have been done have been proposed and implemented by Bitcoin Core maintainers or active Bitcoin Core contributors. So that's historically what has been done. But there is a trend the past few years that more and more of the consensus change proposals that have been developed, thought up, implemented as proposals have been done by developers who are not active contributors to Bitcoin Core and not Bitcoin Core maintainers. So I think that's a dynamic that might change things for how things could be done in the future. It's unclear if it's unclear the path to getting something merged into Bitcoin Core if it's proposed and developed by people outside of Bitcoin Core. So I think alternative clients that have, and specifically alternative clients that include a consensus change and to activate a consensus. And I want to be clear on that because I've seen some reaction so far since we announced that we're referring to just alternative clients that are compatible. That's not what's being referred to here. It's specifically clients that would change consensus, and that I think they're undoubtedly a very important option to have. If we don't have that option, then the entire Bitcoin space is beholden to one project and a few developers working on that project. That's not a healthy Bitcoin. Having said that, to gain adoption of an alternative client is an incredible hurdle. And so one of the things we want to express in this project and in this presentation right now is how difficult it can be to get adoption of an alternative client. There's just a number of hurdles to do so. First of all, there's so much. There's just the network effects of Bitcoin Core and the trust that people have in that software. Imagine if you're a business with millions of dollars at stake. If you're not super motivated for a consensus change, why would you switch to a project that's unknown to you that might introduce risk, security, it might change how you operate as well. So it's very difficult to get that adopted. Just another data point, we can look at how long it takes the network to update to a new version of Bitcoin Core, and it takes a long time, which is frankly a really healthy metric. If it were the case that someone could just push a button and auto update all nodes to the latest version, that's extremely brittle and dangerous, fraught with risk, and would almost certainly be the end of Bitcoin. So it's good that it takes a long time. Another dynamic and change in the space is that mining is more centralized than ever. We want to we want to address that and fix that and make it less centralized. But we've had pools for a long time that are a centralizing force. But with information that was discovered earlier this year, it's even worse than we thought, with many mining pool entities actually just being Bitmain Ant Pool, by a different name, to the point where there's been periods of time this year, in the past year, where almost half of hash rate is controlled by Bitmain in terms of creating block templates and the custodying of the Bitcoin that are mined. Another dynamic in the space is that hash price is at an all-time low, and that just puts more and more combined with the halving, puts pressure on miners to generate profits, and there's just more and more of a focus on fees, and that'll just continue to trend upwards, where fees are going to matter more and more. So miners are going to look for how to generate fees. So what can all this lead to? It can lead to passionate advocates, some of which I think are in the room today, becoming frustrated that the change they want to see in Bitcoin can't be done, or it seems impossible. And to the extent that a change that is desired by a group of people isn't getting the attention of the Bitcoin Core project or merging into Bitcoin Core, there might be alternative clients developed to make that change occur. And then lastly, with the centralization of mining, there is the possibility of just meeting with a few people and being able to change all of the blocks that are produced by mining to support new rules. So what I'm going to speak about the last 5 to 10 minutes of the presentation is a specific scenario that we go through in the BCAT project. It's just one of many possible ways to try to make a change, but we wanted to highlight it as it does highlight some risks that I think all of us should be aware of and concerned of, so that we don't wind up in a very fragile state. So one insight as we analyze this project is that soft fork consensus changes, in theory, can be conducted or attempted and get partial activation with actually a relatively small group of stakeholders. Because mining is so centralized, it is realistic to just meet in a room with a few CEOs of mining pools, and and some folks in the room might want to talk about that. Right now, 3 entities control around 95% of hash rate. It is true that miners, the actual hashers, they do have low switching costs, can switch away from those pools. But at a given point in time, 3 entities can change the blocks that are produced in Bitcoin. So if they could be persuaded to adopt a change, they could adopt an alternative client with that change. And this flowchart here just goes through different paths, but the net is that you could wind up with a network state where a small amount of economic nodes support a consensus change, but 100% of hash rate does. That would then enable the small minority of economic nodes that support it to create new services that are based on that change, and their customers could begin using it. Now, their customers using it, that would be, in my opinion, foolish, because there's not strong enforcement on the network. So there'd be customers locking up Bitcoin in scripts that don't have strong consensus. Miners would be producing blocks, that's good, that support it, and their particular service provider might support it. But what it can do, if we wind up in that situation, it is what we would call a bounty claim scenario. So for those that don't understand how soft forks work, to any node on the network that is not upgraded, a transaction that is compatible with the new consensus change just looks like an anyone can spend. So any unupgraded node automatically validates that transaction. For any upgraded node, of course, it would enforce the new rules that were presented. But the bounty claim scenario is a situation in which if customers are locking up Bitcoin in scripts that use the new rules, let's say hundreds of millions or billions of dollars of Bitcoin get locked up in those scripts, it creates a bounty, an incentive for anyone to broadcast a transaction which spends those Bitcoin. And because it's seen as that anyone can spend by everyone else in the network that hasn't upgraded, you can basically take all that money and send it to yourself. So someone would broadcast that transaction. Now, what prevents that from actually occurring is the miners wouldn't accept that transaction, except if they're incentivized with a lot of perhaps $1 billion that are in the bounty. Then all they have to do is unupgrade. They just go back to the rule set that say 95% of the network is supporting. And then all of that money is shifted from people who locked it up to someone else, including the miners. Now, what also happens then? It creates it creates a hard fork, right? There would be a chain split. There'd be two coins, and it would be a shit show. It would be a total chaos. Let me just say, we don't want to wind up here. That's one reason we're going through this example. And if we do wind up there, though, or any other path where there might be a chain split, you're going to have incentives for every exchange is going to want to list both coins because it's a way to produce fees, revenue for them. And also, if there is contention on which is Bitcoin, is it fork A or fork B, like an exchange is probably just going to, each exchange might act differently, but if they want to be conservative, they're going to just be like, we don't know which is Bitcoin, let the market decide. Well, if we let the market decide, this is when investors become extremely powerful in defining what is Bitcoin. Because as we saw in 2017 with like the futures market for SegWit2x, the original rules chain was priced at something like 10x over what SegWit2x was. And it's unclear exactly what resulted in SegWit2x dying, but that was certainly one factor. If this were to occur again, part of the analysis of BCAP doesn't just say, oh, investors have a lot of power, but we look at each sub-segment. And I think one super interesting insight is that self-custody investors have a disproportionate amount of power relative to their investor peers. And I actually think this is a really good thing for Bitcoin because a concern by some Bitcoiners is the rise in the power of ETFs like Fidelity, BlackRock, et cetera, and what that could mean for Bitcoin. Our analysis shows, though, that they are like investors like that and corporate treasuries, like you'd see at Block, Tesla, MicroStrategy, they're likely to move much slower in such a scenario. Because what is going to set the price of fork A versus fork B are people who are willing to put their money where their mouth is and sell one fork and buy the other one. Self-custody investors are going to be able to do that quickly, and they can make a unilateral decision. Other investor segments are going to be slower. They're going to be far more worried about legal repercussions, and there's way more people involved in making that decision. So I think this is a really key insight. Would love to hear other people's take on that. Okay, wrapping up, several takeaways from this project. There's the 6 stakeholder groups defined, as well as some sub-segments within some of those groups. Actually, I forgot to make the specific point, but with Bitcoin Core, as mentioned, it's the dominant network implementation on the network. And I often hear people say that Bitcoin Core maintainers have too much power to change Bitcoin or that they can introduce change. I think that's like clearly false. And many people have written about that, explaining why. However, the flip, I think, is true. I think that they do have veto-ish power from not changing Bitcoin because of how predominant Bitcoin core is on the network. So I think that's an interesting point. And other takeaways are just like the scenario we just walked through. Let's avoid risky paths. So one advice I would personally give for anyone wanting to look to make a change is really try to get that, prepare the material and the arguments so that folks contributing to the Bitcoin Core project are motivated to look at it, or begin contributing to Bitcoin Core project yourself. I think that's a far healthier path to make a change. So with that, thank you very much. There's a list here of all the people so far who have reviewed and engaged in this project. But as mentioned, it's an open source project available for anyone now. It's really the beginning, not the end. So there's undoubtedly many ways to improve this project. So we would welcome everyone's contribution.